Welcome, everybody, to the No Income, No Problem webinar. I'm Cindy Bishop with Cindy Bishop Worldwide, and would like to introduce our speaker today in just a minute. The topic today is a very powerful business creator and helps many buyers. A lot of people don't know that this kind of program exists in today's climate. This topic is important for all of us because it will help your clients reap the benefit of your knowledge and aiding them to seek out better ways to secure superior loan variety. Our speaker is fabulous with an abundance of lending experience and is with New American Funding. He is also well respected software trainer with Cindy Bishop Worldwide. Please welcome Jim Perkins, your presenter for today.
Hey, thank you, Cindy, and appreciate that introduction. And welcome everybody to the webinar today, No Income, No Problem. And what we're going to talk about, basically three particular loans, but we want to try to give you a broad brush of what these programs are and how you can use those to close more transactions. And it just gives you a lot of more flexibility, and especially in this market where you're seeing there's a lot of challenges. And as underwriting guidelines change and get a little bit stricter, these programs might help you, like I said, generate more business and actually just give you another tool to help your clients and borrowers being able to purchase more homes. So I'm Jim Perkins, your instructor for today's class, and just basically licensed all the way down the East Coast. And we're able to do loans on all 50 states and Puerto Rico also. So if you have somebody that's looking to buy outside the area, we can certainly help them. And let's see. So the overview today, we're going to talk about investor purchases. Is one of the loan programs that we're going to focus in on. And then a loan program called asset depletion loans. And we'll get into details on those. And then the last one we'll talk about is what they call bank statement loans. Now, these loan programs, some of them have been around a longer time than others, but you're constantly seeing that these loan programs are changing on pretty much a consistent basis, because what they're doing is they're reviewing the statistics of how these loans are working, how they're performing. And so you might see tweaks going on from time to time. So if you do have somebody that you think might fit into one of these programs, I mean, basically what we try to do is get them into the system so we can see what their actual picture is, and then try to find the best program that's going to work for them. So let's start with the investor purchase, the no income. So you say debt service coverage ratio. So this is commonly known as a DSCR. So the DSCR stands for the debt service coverage ratio. So, and you'll hear this a lot, DSCR. Do you have a DSCR program? So it's a program that's specifically designed for investment property transactions. Okay, and they can only be used for investment purposes or business purposes. And what do they mean when they say business purpose? They're basically talking about renting it out. So they don't allow these programs to be used as like a second home or a residence that a person might move into. It's strictly just used for investment purposes, or what they call business purposes only. And they'll actually sign a disclosure that will say that. And so the qualification is based on the cash flow of the subject property. Now, a couple of slides down, we'll get into the details of how the qualification is. But this kind of takes away, especially if you have investors that have more than one property, because several years ago, Fannie Mae and Freddie Mac changed the way they calculate the income on a person that has investment properties. So it's a lot more restrictive. And what would happen is we had people that used to qualify carrying those properties that no longer do, because they're not, like I said, it's not as flexible. It's not as, I guess, generous as far as the income that they're using for qualifying somebody. So what this program does is this kind of gets around that, because if they meet certain criteria, basically they're not going to be looking at their income at all. They're just mainly looking at the cash flow that's coming in on the subject property, and they're matching that up with the debt to income ratio. So the DTI. So it's basically just the income coming from the rental of the property or the income that's generated from the property against what the PI, TI, uh, uh, principal, interest, taxes, and insurance, and then any type of HOA fees or condo fees if you have those. So the borrower employment they're not even looking at the borrower's income, is not required on that. So there's no, like they said, there's no DTI or debt to income ratio for qualifying. So they're looking specifically at investment properties only. The loans must be business purposes only. So like we talked about, so nothing that you can use as, like, say, a second home or that something that you're going to be moving into. They're going to be looking at 6 months reserves based on the principal, interest, taxes, and insurance. So say if it comes out to, like, say, $2,000 a month, then they're just going to multiply that 2,000 times 6. And they want to see that after closing, they're going to have that in reserve. So $12,000 somewhere. So 3,000 or 4,000, whatever it turns out to be, just multiply it times 6. And that's what they'll want to see as far as the reserve requirement that they have. So the minimum DSCR ratio is 1, and they'll also go down to 80 or 0.8. And they'll require a little bit more down payment when it goes to 0.8. And they have an example further on down the couple of slides, and we'll basically review with you what these ratios mean when they say 1 or when they say 0.8. So the 12-month housing history on a primary residence. So borrower needs to own a current home and have a primary residence and be their primary residence, and they want to see a 12-month history on that primary residence. And then the insurance that they get for the property, they want to see a 6 months rent loss coverage. In other words, if something happened to the property, they want the insurance coverage that they're paying for, the homeowner's insurance, to cover 6 months of the rental income that they might lose. Because normally within 6 months, they're going to be able to repair any type of damage that might have happened to the property on that. A lot of actually construction loans are 6 months. So they're, even if they had to build it all the way from the ground up, they should be able to do that. So other borrowers' eligibility, they'll go down on this particular program. The minimum credit score to go down to is 660. Now, I want to point out that this is different investors have different guidelines. So this is just to give you an idea of a broad brush. You might have an investor that might go down a little bit lower to say 650, or they might have investors that say, hey, we require a 680 or even a 700. So, and that's why we say it's important when we have somebody we know that's going to fit into this type of range or this type of program, we get them into the system and then try to match them up with the program that's going to work best for them. So first-time home buyers are not allowed, but first-time investors. So they will allow a first-time investor, and they defined a first-time investor is somebody that has not owned an investment property for 12 months in the last 3 years. So that's almost like a first-time home buyer, haven't owned a home portion of your principal residence in the last 3 years. But this is an investment property, and they want to see that you've had it for at least 12 months. So, but they will allow that, but you have to own, like we said before, a primary residence. The minimum DSCR score is 1, and the maximum LTV is going to be 70%. And what that means is they're just going to be required to put at least 30% down on that. So the investment purchase, what you're looking at is they will allow a long-term rental income. So, and that's would be like, say, your standard investor property where somebody is buying a house and they're getting somebody to, sign a 12-month lease on it. So it is something that they do allow on the long-term rental. And what they're looking at is they'll use 100% of the lesser of if they have a lease or if they have, the appraisal rental comp. So on this type of program, and just like if somebody was doing a standard investor loan, the appraiser would do what they call rental comps, and they'll come up with what they consider to be a fair market value for rental for that particular property in that particular area. So when they say the lesser of the two, so if you had a lease, actually, if you had a lease that was less, we probably wouldn't want to see that if it was less than the rental comps, because the rental comps would give you a little bit more flexibility. Now, some of the investors that are coming up with these programs and realize that these programs, because the market has changed, the inventory is so low, and then the competition for properties has increased dramatically. What they're trying to do is come up with programs that are going to be a little bit more flexible and help people as far as purchases are concerned. So some of these programs will consider short-term rentals. And so when I say short-term rental, gee, what is that kind of like? Well, they're basically talking of something that's like an Airbnb. Now, it doesn't have to be an Airbnb. I've done some loans that weren't like in the Airbnb system on the Shenandoah River, actually, where people are renting those out as short-term rentals, where it's renting on, per night or per week. And amazingly, they're getting some pretty good prices for out there on the Shenandoah River. But so they will consider that type of rental income. Now, the way they'll establish the income is they're going to rely on the appraiser to establish what that income would be for a short-term rental. And then he's going to have to do some research for that. But to also look at a 12-month statement from a seller, like a third-party management company. Now, most of the time when people are doing these short-term rentals, they are doing it as like say through Airbnb, where you would have those records. Or I know the people that I've done some loans for, like say out on the Shenandoah River, they're going through a website that tracks all that information. So that would be something that they should be able to generate on that. But it's the type of thing, and we would get that, like I said, from the seller. But it is something that they would want to see, a consistent rental pattern on that. And it doesn't have to be like short-term rental. It doesn't have to be like say every week or every day, but something when you're looking over 12 months that they're going to be using that income, a standard income. So the calculation for the DSCR, so the debt service credit ratio calculation, is when they're saying one, they're looking basically a 1-to-1. So if the rent is $4,000 a month, then they want the monthly payment to be $4,000 a month. So that's pretty easy. So they say, hey, we're looking to buy this property. We want to put this amount down. The rental comps that we're looking at the property, say they're 4,000, and we're working out the principal, interest, taxes, and insurance, and any type of HOA fees that you might have. So if that equals 4,000 or less, then you're pretty much in the picture as far as qualifying is concerned. Now, obviously, they're going to be looking at certain credit ratios. So obviously, the credit scores, the higher the credit scores, basically, the easier it's going to be for somebody to qualify. And usually, you can qualify for less of a down payment. So on example number 2 that they're looking at here, if you're going with a 0.8 ratio, so they're going to require at least 30% down on the 0.8. But what they're looking at is they would take the gross rents, like in this case, they're saying $3,200. So it doesn't come into what the monthly payment's going to be, but dividing that rent, that $3,200, they're dividing that by 0.8. That comes up to $4,000. So as long as the monthly payment is $4,000 or less, then the person qualifies, assuming they meet, the down payment requirements and then also to the credit score requirements. So when you think about it, a great program. I've done a number of these. I've done a couple in Florida. I'm working on one right now out in Warrenton, where people are, they have the money, and the down payment is very similar to your standard down payment program. And it just, because it's just looking at the monthly payment and what the rents will come in at, depending on the area that you're in, this could be a very attractive program for investors, especially if they're in a situation where they can't qualify for the standard qualifying that you would see under a standard loan program for investors. So the business purpose requirements that they're looking at, so business purposes and occupancy affidavit. And then what that means is they're basically going to sign a disclosure that says this is property is strictly for rental. We will not be occupying this property. We'll be not using it for any personal use, period, on that. It has to be an arm's length transaction, and that means you can't be buying from a relative or some type of relationship that you have with the seller. The buyer can't have. So the down payments will work better for the program, and it's optimal. The sizable down payment, 25 to 35% down, is usually what we see works the best, and it really depends on the area, what the rentals are for the area. Because some areas, the rentals are going to be higher than what the total monthly payment's going to be, and in some areas where it's lower, so they're going to require a little bit more as far as the down payment is concerned. So now the types of loans. So what they're looking at here is 80% to $1 million, and that would be a 1-to-1 ratio. So we had mentioned before, if the rent's $4,000, then the monthly payment can't exceed $4,000, and they'll go 70% to 1,000 at 70% to 1 million at a 0.8 ratio. So that gives you a lot of flexibility. And then right here, this kind of gives you an idea of what you're looking at with a 25% down with a credit score of 720. You're looking at a 7.25% interest rate with points of 1.5. Now, most of these type of loan programs are going to have points associated with it. But if you think about it, that 7.25% is not really that far off from what a standard investor would be getting in today's market. And the other thing about it is it's so easy to qualify if they meet this scenario. And a lot of times we'll take these loan programs and they believe that it's going to be close to the 1-to-1, but we always set the expectation and let them know that if it's not the 1-to-1 ratio, we have the flexibility of going down to that 0.8, and that would certainly give them the room to be able to still qualify for the loan program. Okay, so the next program that we want to talk about is the asset depletion program. Now, remember, this is just a broad brush, so there's a lot of more details associated with each loan program, but this is just, what we want to try to do is, get the wheels turning for you. Say, hey, you know what? I know this person, and they didn't qualify because of this, or, an investor that has it. And then this might be a program that might work for them. So, and like I said, we try to get them in the system and determine where they are, what their situation is, and then move them in a direction that they'll be able to qualify based on what their goals are, what they're trying to accomplish. So the asset depletion program. So it's basically the asset amortization is creating a stream of income from specific asset types. It can be used with other sources of income or independently calculate the income. So what they're doing is, and it says net eligible assets divided by 84 months. Now, some people are thinking, well, heck, if I'm dividing it by, that means like in the example here, example 840,000 net eligible assets divided by 84 months equals $10,000. Okay, they have to be taking $10,000 out of that eligible asset in order to qualify. They don't have to be. So what happens is they're just saying, hey, they have these assets, and what we're going to do is we're going to credit them based on this calculation. We're going to credit them $10,000 a month, just like they were receiving that $10,000 a month. So that is really flexible and really helps people. Now, on this type of program, they're looking for somebody obviously with a little bit higher credit scores on that. But now in example 2, so this gives you 400,000 of net eligible assets divided by 84 months. So that gives you $4,761 that they're using as qualifying income. And like I said, the person doesn't have to be getting that income from that asset. In other words, they don't have to be drawing that up or set out a payment plan where they're actually pulling that money out on a monthly basis. It's just because they have it, they're allowing them to use that as income for qualifying purposes. So they can use, and the beauty of this type of program is that's not the only income that they can use. So they can use other income too, like W-2 income or Social Security income or pension income. Now, where I've seen this used mostly is, I won't say mostly, but people, I've used it, they will allow primary residence and they will allow second homes on this. And I've seen it where it's like a second home program where a person might be retired. I had one recently where a woman was retired. She had a nice chunk of change because her spouse had passed away, and they had been in investments that they had over the years, but also she had money that had come into her possession from life insurance. And so what she was looking to do is she wanted to buy a second home in an area that was close by the water so she could enjoy it with her children, the grandchildren, and then pass it on when she was no longer here. So she used it, but in her situation, she had retirement income, like a pension, but she did not, and Social Security, but that would not allow her to qualify. But what we did is we used this program, and what they did with that, then she was able to use that assets that she had in order to generate enough income where she was easily able to qualify. And so it worked out pretty good where she was in a situation, she was qualified, she was able to get the house and super happy. I just talked to her a couple of weeks ago and she was really happy, really enjoying the property, and said they go there almost every weekend as a second home. So it's like I said, it's another program that's coming out, and it's kind of creative when you think about it. But what they're looking at is they're saying, hey, this person has enough income to be able to possibly even pay off the loan or generate income on a monthly basis if they had to take money out of this asset. And it would give them the flexibility that if they got in a situation where their income stream had stopped, then they would still be able to make it from the asset that they have that they were showing. Now, depending on the type of asset they have, will determine what the qualifying that they will give that. So it said, on the slide before, it said eligible assets. Well, and this shows you here a depository. So checking, savings, CD, money markets. So those are pretty standard. You know that the principal balance of those is not going to change. So they'll give you 100% of that value of that asset. So if you have marketable security, so basically stocks, you might have, stocks of, like, say, Microsoft or Amazon or, whatever the Starbucks or whatever the company is, they'll take 80% of what the value of that stock is, and then they'll use that, again, divided by the 84 months. Retirement accounts, and they split this up between 59 and a half, because after that, you can take it without any limitation on it. So 80%, if in a depository, they'll give you 100%. And if you're less than 59 and a half, it'll be 70%. And if in a depository, then they'll give you 90% on that. And then cryptocurrency, because they're not too sure about that, 25% of the net eligible asset. And I think probably over time, as cryptocurrency becomes more acceptable, you'll probably see that percentage of that asset will actually go up on that. So now ineligible assets, so they won't allow, like, say, gift funds. This all has to come from the person's own assets. They won't allow business assets, so won't allow income, or if the business has a certain accounts in their name, they won't allow them to use that. The cash value of life insurance. So what the cash value of life insurance is that if you have life insurance over time, it develops a cash value. So they won't allow you to use that cash value as an asset for the qualifying. Stock options. So options are basically options to purchase stock that haven't been exercised yet. And so they won't allow you to use that. And then any foreign assets. So basically what they're looking to do is they're looking for assets that are going to be, in the United States, that they're going to be easily verifiable, and so that they can, track it. So additional requirements. So they're going to be looking at 3 months consecutive bank statements within 60 days of the note date. Now, so when you say bank statements, if they have it in checking or savings, a lot of times when people have this amount of money, they might have a financial planner. And so what they would do is they would get 3 months statements from the financial planner. And when we go back to the types of assets that they're looking for, they're very flexible when they're talking retirement, because there are some programs out there that will not allow retirement incomes, or if it is a retirement account, it has to be developed in a certain way. So it has to, some of them are restricted that you can only use retirement account if it was structured through, like say, an employment history on that. So it's the type of thing that, again, like I said, we try to get the people into the system and then match them up with the program that's going to best suit them best based on their circumstances. So assets used for down payment and closing costs and reserves must be excluded. So, say if you had $1 million and then, you're going to be making, say, down payment after you subtracted out the down payment, the closing costs and the 6 months reserves, you only had 700,000, then that's what they were going to be using as far as the qualifying income, or using that income to be qualified. And then all individuals on the account must be a borrower on the loan. So it's not something that you could have 2 or 3 people on the individual asset account and they're not on the loan. So everybody has to be on the account in order to be able to use it for the loan program. So now the LTVs, so the credit scores and the DTI rates. So 85% to $1 million, 80% to $2 million. Credit scores, what they're looking at is 700 and above, and the maximum DTI is 50%. So 80%, just to give you an idea, so the rates today, an 80% LTV with a credit score of 720 or more, you could get 7.5% with 0 points and 7.125% with 1 point. So it gives you, like I said, a lot of flexibility on that. The thing to remember is that there's a number of different investors out there that offer these different types of programs. And so you might have, like we said, like the credit score here says 700. We might, if you had somebody that was say at 690 or 685, say, oh, they don't qualify. Well, then there might be another program that might work for them. The thing to remember too, especially with the credit scores, is the credit scores are just a snapshot in time. And so if somebody comes up and their credit score is a certain number, then over time, we might be able to get them to make some adjustments to the credit. And we've been able to do this like within 30 days sometimes, but make adjustments to their individual credit profile that will bring those credit scores up to put them in a situation where they would be able to qualify for the program. And actually, the higher the credit score is going to be, and this is true with any type of loan program, the higher the credit score, usually the better the rate's going to be, or the cost for an individual rate will be. And then also too, it just put them in a better situation as far as the loan program is concerned. And they might be able to qualify for more loan programs based on a higher credit score. So, and that's another thing that we always take a look at is when we get somebody into the system, is we will tell them, this is your credit score now, and this is where, it's going to be, if we can get that credit score up, and sometimes it's just like 2 or 3 points, which can be done relatively quickly. But sometimes it might be more. It might be, like 20 points or 30 points, which might take a little bit longer time. But that's something that we try to look at to see if that would put somebody in a better situation. And so, and I've done this on a number of loans where, and this is even on standard loans, where the person, had a credit score of a certain amount, didn't qualify for a program. And then because we worked with them for, like, say, a month or two, and were able to get their credit scores up, then all of a sudden they're able to qualify for the loan program that we were looking at. And that's, and this is a little off topic, but that works really well for first-time home buyers, because if you have somebody with a first-time home buyer, a lot of times they don't get dinged for lower credit scores as far as the rate's concerned. And so if you can get them up into the area that they'll work for the program, it doesn't matter if they have a super high credit score or just one that just gets above the minimum credit score, the rate's still going to be the same. So that's the advantage of that type of getting, looking at the credit score and trying to get it up into an area that will work for whatever program they're looking at. Okay, and now they want to talk about a bank statement program. So this program is designed for people, generally speaking, people that are self-employed. So designed for borrowers with active U.S.-based business that is generating stable income. And so a lot of times when we're looking at people that have businesses is that they're writing off a lot of expenses. And so it's very hard for them to qualify because they're writing off a lot of their business expenses. And what we see is sometimes is that they say, hey, I've got the income, but if we're looking at the bank statements, the tax returns, they don't qualify because they're writing off all those expenses. And the reason why they're writing off all those expenses is to put them in a situation where they have to pay less taxes. I mean, basically, they want to, everybody wants to pay less taxes. So the more expenses you can write off on the business, the better situation you're going to be as far as the amount of taxes that you have to pay. And you see, large companies do this all the time where they're hardly paying any taxes because they're using the tax code to write off the income so they don't have to pay taxes on it. Okay, so the bank statement program, so general criteria, so verification that the borrower has been self-employed in the same business for at least 2 years. Now, generally speaking, they're going to be looking at the 2 years tax returns is what they're going to be doing. But you could generate this by looking at the business license that the person has been looking at that. So again, depending on the investor will determine what their requirements are. Now, on minimum ownership of the business, at least 25%, and you can establish that from a letter from a CPA. Okay, and then provide a signed written business narrative. So this must include description of the business, so what type of business operation they're in and how they're doing business, primary services and products that are offered through the business, and then their customer base, what their customer base is, and then the number of full-time employees. So when a person is providing this narrative to us, and then even if they are say on a general loan and they're getting what they call an LOX, letter of explanation, if they're getting like say credit or something like that, when they provide this information to us and it doesn't quite meet the standard, then we'll kind of guide them and direct them and say, okay, you really want to structure the letter this way, or you want to make this a description or narrative in such a way that's going to fit the purposes of the loan. So it's not like they're out by themselves and just say, oh, no, it doesn't work because your narrative wasn't correct. We would kind of help them structure it in a way that would fit into what the investor is actually looking for on that. So what they're looking at now, again, depending on the investor, but from 12 to 24 months, complete and consecutive bank statements within 60 days of the note date. So 60 days of the actual closing. So when they say complete, they want to see all pages. So a lot of times you'll have a bank statement and, it might be like 8 pages long. And the last 2 pages might be advertising, or there might be a page in there that's blank. They're going to want to see if the first page says 1 of 8 or 1 of 10, they're going to want to see each page that says 1, 2 of 8, 3 of 8, all the way down to 8 of 8 on that. Because what happens sometimes is on some of those pages, there might be something put in there that might be a concern as far as the loan program is concerned. So consecutive bank statements, they'll want to see that, every month there's, if it's going back 12 months or if it's going back 24 months, there's not a month that's skipped. Now, we see that sometimes we're able to get away with that if we're showing, like, say, alimony or child support. They want to see so many months, 6 months or 12 months. So, I'm missing this month, but you can see that I'm getting it every month. Then that's something that we usually can get around with. On these type of programs, because they're looking at the income that's being generated from the bank statement that they're showing that's being deposited into the account, they're going to be pretty strict as far as it's got to be consecutive. So no skip months as far as payments are concerned. So they will allow multiple accounts. So accounts, they may have 2 or 3 different accounts that they'll allow to be used. And the business activity on a personal account is okay. But generally speaking, a business account is going to be a lot easier because the transaction in there are associated with the business. If it's on a personal account, it might be a little bit tougher to kind of pin out what's business and then what's personal in there. And then you would think that most people that have, generating businesses that are going to use this type of program are usually going to have like an accountant. They're going to have a business account, accountant handling the business. So it would be unusual that if you had somebody going with this type of program that was, had the money deposited into a personal account and not a separate business account, and they were trying to handle the taxes and everything on by themselves. Could be done, but it just makes it a little bit more difficult on that. So ineligible deposits, so transfers from other borrowers' bank accounts. So if the borrower is transferring, like say from a personal account, if they're transferring from their personal to the business account, they won't count that as an eligible deposit that will be used for qualifying income. So tax refunds, if they get a tax refund that they're depositing into the account, they won't count that as, like I said, qualifying income. And then loan proceeds, if they're getting a loan and they're getting either monthly payments from the loan or they get one chunk deposit on a loan, they're not going to allow you to use that or allow them to use that for the qualifying purposes as far as the income that they're using, that they're showing or being generated from the bank statements. So any non-business related deposits. So what they're specifically looking for is income that is going to be consistent and is showing up on the bank statements. And like I said, a business bank statement is going to work a lot easier, but so any type of deposit that's just like a one-off. And that's why they say that the tax refunds, because that's something that's only going to happen once a year if it does happen, even if it does happen every year. Or like the loan proceeds, that's something they're going to go out and get a loan and then drop that money into the account. It's not something it's not income that's being generated from the ongoing business. So that's not something that they're going to be using for qualifying income. So the business expense letter, so what our expense factor, so the rule of thumb is 50%. So what they're going to do is they're going to be looking at the income and developing a monthly income based on all the bank statements that they have. They're going to generate a monthly income, and then they're going to take 50% of that income to use. They're going to estimate 50% as an expense factor. So they're spending 50% of the income for expenses, toward expenses, and then they use the rest for qualifying purposes. Now, the important thing to remember here is not all of the investor programs that have bank statement programs will go to 50%. I've seen some go as high as 60 and some even at 70%, but they will, they're a little bit stricter in other areas on that. So again, since this is just not one standard program, like you would see like say a Fannie Mae or Freddie Mac or FHA or a VA program where there are certain standards that are across the board. These programs are developed by individual investors. It could be like a retirement pension fund, or it could be an individual bank that's providing this particular program. So it could come from a lot of different places, and each investor, we call them investors, but each investor that is offering this type of program is always going to have their particular requirements. And so like this one, probably the most conservative is 50%. And just like the asset depletion program, where they're saying 84 months, there are programs out there that will actually go to 50 months or 60 months, but they're much stricter on the other areas that they're looking at. And that's why, again, that we always say, what we try to do is get the people into the system, and then based on what they're trying to accomplish, we try to structure or find the loan program that would fit best for them, depending on whether it's a bank statement program or a DSCR program or the asset depletion program on that. So, because there's, like I said, there's a lot of different programs. And the other thing to remember is that these programs change from time to time, and sometimes they not always, but a lot of times they'll make a change and they'll say it's effective immediately. A lot of times what they'll do is they'll make the change and they'll say, okay, you got 2 weeks, or if you have any loans that you've already taken the application or that are under contract, we'll allow them under the old guidelines, but anything going forward, it'll be the new guidelines. So if you're working with people like that, you just want to make sure that one, what the time frame is and how they're moving forward as far as the individual loan program is concerned, to make sure that they're going to fit under the guidelines and they're not going to change on them. Okay, and then on this particular program, the bank statement program, the LTV and credit scores and the current rate. So the LTV, well, they'll allow them to go to 85% up to $1 million, and then 80% to $2 million. And so what they're looking at here is a minimum credit score of 700. And again, I just want to reinforce that different investors have different requirements. So you might be able to get somebody that has, like, say, a 680 credit score, or they might be a little bit more flexible as far as the LTVs based on the actual loan amount that they're looking at. So to give you an idea of what you're looking at today is like 80% LTV with a credit score of 740. You're looking at 7 3/8 on a 30-year at 0 points, and 7% on a 30-year at 1 point. So you can see these rates on all these programs are a little bit higher than what you'd see on your standard loan programs, but they are, and the reason for that is because there's more risk associated with those. But they're basing it on, they've come up with the criteria that they believe that will be something that will work for the individual, and at the same time will not put them as risk as investors offering these type of programs. And that's why you'll see from time to time they'll get tweaked as far as maybe the down payment requirements might have increased or they might have decreased. And the credit score is the same way. Hey, if they got a credit score that's 700 and then all of a sudden now they dropped it to 680. Now, why is that? Because the 700s may be performing perfectly. And they're saying, well, we're willing to take a little bit more risk, so we'll lower that credit score down a little bit lower under that program. So remember that these programs, and what we're doing here is just a broad brush, just to give you an idea. There's a lot of different programs out there, but to give you an idea, maybe start the wheels turning for you that might generate some ideas that will help you generate more business, get more of your clients into homes that they're looking to buy, especially I would say, because being participated in all these loan programs, the DSCR program and the asset depletion programs are the ones that I've seen work probably the best, and also probably more of them, just because as time goes on with the DSCR, if you can match that up, it works out really well. And then investors are usually looking to put 25 to 30% down anyway. Sometimes you'll get them at 20%, but if they have good credit scores, you can still work them under these programs. And then the asset depletion, you see a lot of people with a lot of reserves, and before they just weren't able to qualify for a loan because their monthly income that they had wasn't enough to qualify them under the standard loan program. So with the asset depletion, what they're doing is, and we see this from time to time, where they have their assets with a financial planner, and they may have like $1,000 or $2,000, $1 million or $2 million in assets. That's going to allow them to qualify for a considerable amount based on the loan programs. But the other thing to remember too is that these loan programs, because they are specialty programs or investor programs, not all of them, but some of them may have to go to the individual investor themselves. So when we do a lot of these programs, we call it's a delegated underwriting. And that means that our company underwrites the loan program. Some loan programs you have to send to the actual investor, and then the investor has to underwrite the loan program themselves. So that makes it a little bit stickier. Sometimes they're a little bit more finicky as far as what they're going to be requiring it. And if it's not a delegated program, like say if it has to be sent to the investor, then generally speaking, it'll take a little bit more time. So it's the type of thing that you don't want to see where you're going, like say on a 19 or a 21-day close. If you're using this type of loan program, then you probably want to go to like a 30-day closing or longer on that. But it also depends on how long you've had the individual in the system. So if we've been working with somebody and we've gathered their information, and what we'd like to try to do is gather their information and then run it by an underwriter. And so that they've had an underwriter review once already. So we know that the contract that they're writing, that they're going to be qualified for it. It's just going to be picking up the little bits and pieces of information so that we know that, like I said, that contract is going to go through. That would be able to go a little bit quicker than somebody that, hey, I want to write a contract and I think about using this type of loan program where they're just putting the information into the system, because there can be a lot of, like I said, tweaks to the program that are going to require additional information or a little bit more long time in order to document that information that they're going to require for the people. And then I believe that's the last slide. So thanks for attending. If you have any questions, we're done a little bit earlier, about 8 minutes or so. I'll be more than glad to answer any questions for you. I believe that Cindy will be sending out these slides to everybody. So if you have any questions, my information is on the slides. So feel free to reach out to me, even if it's not a particular program like this. I do all types of programs. And even if you're just trying to get some clarification or you're trying to get an idea of something, hey, I've heard this, or is this type of program available? I'd be more than glad to help you guys out. This market is really tough, and I know that it hasn't gotten easier with all the commissions, structures, and changes that we've seen. So, like I said, there's some changes because of that you're seeing under what the lenders are going to require also, as far as documentation is concerned. So if you're seeing something, you're not sure about it, or you're just trying to get some clarification, like Cindy says, I've been teaching all different types of courses for quite some time with her, and I'd be more than glad to help you guys out. It's all about us, generating more business. We're all paid on commission, so we want to make sure that we're helping each other to grow and prosper.
Hey, Jim,
Anyway, yes, ma'am.
that phone number's wrong. I put it in the chat. Everybody gets I just have you call me on my cell, 540-846-6641 in the event you want to contact me or the school. Also, I'm not sending the slides out.
Okay.
I'm putting the replay on your instructor page at cindybishopworldwide.com. Yeah.
Okay. And what's that number? Because before I send it to you, I will change that number.
That'd be great. It's 540-846-6641. I'll send you the roster. If you want to send these slides out, you can.
Okay. I'll send it to the people that are on the roster. That'd be great.
That'd be great. And then I'm going to put the replay on your instructor page. It's also on the blog on cindybishopworldwide.com, just so you guys know.
Okay.
When I get it rendered, it'll take a couple hours.
Okay. Did anybody have any questions? That means I taught a great class, huh?
Yeah, it was very thorough. All right, guys. Well, have a good day.
We'll talk to you guys soon.
All right. Bye-bye.
Okay. Bye-bye.
Thank you.
Welcome.
You're welcome.
Bye.